this has been a steady dividend payer and grower for the past 4 years. Now, their all-time high is around $80 a share, and it's currently trading at 41. So if it can get back to 80, not only am I going to be enjoying like those dividends, but the capital appreciation is going to buy my next, Florida home for me. So
next to the celebrities.
That is the number one dividend stock for me for 2024.
All right, let's get started. Welcome to the Angel Research Podcast. My name is Jason Freert. I'm here with Brian Hicks.
Hey.
Founder.
How's it going?
The founder, Brian Hicks of Angel Publishing. Welcome back.
Thank you. It's great to be back. It's been a busy week for me. My 2 daughters came home from college yesterday, so my house has been a madhouse. They brought all their stuff back from their dorms.
Wait, they didn't stay at college and protest?
No.
Was there protest at their college?
Not that I'm aware of, and I probably would have heard, but no, not that I'm aware of. So
gotcha.
Good.
Good.
So we're not paying $70,000 a year for nothing.
So, and you just got back from Florida, right? How's the weather down there?
Oh, the weather was great. It probably averaged 80 degrees every day. It was full sun. Housing market is starting to correct that down there in Sarasota and Bradenton.
So what, stuff's on the market more?
Stuff's on the market more, a little bit longer, and sellers are reducing their prices now. So every time we go on, because my next door neighbor is actually a real estate agent. I actually like talking to real estate agents rather than like poring over data.
Oh yeah, they're the boots on the ground,
they're
right?
The boots on the
know.
ground. And she was telling us that it's still pretty strong, but it's not as strong. And sellers are beginning to reduce their asking price. So
is that just because they were asking ridiculous prices to begin with?
Well, look, you can. The one thing that I do look at in terms of data is tax assessment history, okay, and for a particular piece of property. And if you look at it, they can chart. You can go on Zillow and just look at the chart,
right? And
you can look at the chart going back as long as the data is available, and you'll just see like a steady tax assessment, boom, 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 and then in the past 2 years, the tax assessment just went like that. So just like stocks, it had to correct.
Right.
It had to come down, and so you're seeing that, and houses that were, a year ago that probably would have gone for $700,000 are now probably being priced at around $550 around there. So
that's a decent correction.
Yeah.
Down.
So it had to correct. It was getting a little crazy out there.
Yeah, I mean, and just with the interest rates, like unless you're buying straight cash. Although I feel like in that area, there's probably a lot of cash buyers, retarees.
Well, that's our neighbor told us that most of the purchases, at least on Longboat Key,
right, is
all cash.
Yeah.
Granted, where my house is in Sarasota, it might be an exception to the norm because of where we are. I have celebrities around me now that are paying, buying with cash. But if you go outside of our island, Longboat Key, you can definitely see the housing market beginning to correct and to revert to the mean, so to speak.
Right. And we're still in that, I guess, boomer retirement trend, right? I mean, how long have we been quoting this statistic of like 10,000 baby boomers retiring, like a day? Is that still happening?
Yeah, it's still happening, right.
For the foreseeable future.
Yeah, so I was born in 1968. I don't want to date myself. So I think the generation cohort, I was 2 years behind being a boomer, which is crazy. I can't imagine myself being. I'm actually Gen X,
right?
Which means the last of the boomers were born in 64, 65. So I'm 55 years old. That means, if you're 60 years old or 58, 59, you're still considered to be a boomer. So there's a long way to go before that boomer retirement trend exhausts.
Right.
So we're gonna keep seeing it for a long time.
And a lot of these people might be cashing out their retirements or coming out of, we talked about it last time, just the big, you know, money market stuff on the sidelines.
Yeah, there's a ton of retirement capital out there still. I think the last time I checked, it was something around like 37. Man, I don't know the figure off the top of my head, but it's like something like $7 trillion or something like
Right.
that. And but the funny, maybe we can pull this video up. I saw it on TikTok, Tyler, and it was this old guy. He was dancing. He's like, dude, like really old, like, and the caption was, baby boomers who bought their first house at $7,000 cash out at two million.
Yeah, my favorite too, which is where I'm at, is the meme of people that refinance their home at like under 3% mortgage rate.
Yeah.
Which is like just 2 or 3 years ago you could get rates that low, and so I refinanced and like I'm at like a 2.75. I'm like, why would I get rid of that now? Like it's fiscally irresponsible to trade that for a 6 or 7 or whatever. It's approaching 8 in some instances.
Well, yeah, that's the argument, is that supply is still tight because people who refinance their mortgage below 3%, they don't want to sell and move, and because they're going to have to refinance at a higher rate. And it's funny too, Jason, because Florida in particular was a high demand state for the past 3 to 4 years because of COVID. And so we're seeing houses on the market in Florida longer than usual than what probably the national average. Here in Maryland, you put a house up for sale in Maryland, there's a contract within a few days.
Yeah.
So I still think the housing market it's still a regional thing. But yeah, I think there's this argument, and I think it's a valid argument, that the younger generations are having a hard time buying houses, not just because of supply, but they're being priced out because of the higher interest rates.
Oh yeah, absolutely. I mean, you've seen those charts of a $400,000 house at 3% versus 7%. It becomes from like kind of affordable to just unaffordable.
Right.
So,
I read something recently that it's still cheaper now. It's cheaper
to rent
than to buy a house. So.
Yeah, absolutely. So it should correct, but I guess we'll see how it plays out the rest of the year. We were talking before about dividends, right? I actually read an article just before. I think I was going to send it to you about the tech stocks, like the big tech is starting to embrace dividends, right? Apple has a dividend. I think Meta is talking about doing a dividend. I don't know if they already have a dividend. So it's kind of the old school thought was a tech stock is a high growth stock, so they want to invest all their capital. But now these Metas and Apples and all these, they're almost becoming like industrial level like dividend payers.
Yeah, and I'm currently reading this book, and this guy is making this argument that we might be entering a new era of where dividend is king. For the past 30 years or so, especially in the 1990s, there was this push not to pay dividends, companies not to pay dividends. There was no reason to pay dividends. And investors weren't looking for dividends. They were looking for capital appreciation. They were investing in growth. I think, there might be, me, Jason, I love dividends. I love both. I love growth and dividends. If I can get both, that's the best of both worlds. But yeah, I think dividends is, income through that is a growing trend.
Right.
Okay.
So let's talk about your. It's probably been over a year now where you had your dividend statement come out. Is it still? Have you allocated that portfolio any differently? You're still collecting the checks, the actual physical checks.
Still collecting the actual.
How do you deposit them? Do you do like the mobile deposit, or
Yeah,
you just
yeah,
do that?
yeah. Just I sign it, give it to my wife. Like as always, we give our checks to our wives, and she takes a picture of it and
And
deposits
then
it
puts
that
it in
way.
there.
I guess I'm old school like that. I don't know, but yeah. And I can talk about my favorite. My it's still my number one favorite dividend stock. The name of the company is MPLX, and it's a master limited partnership, does oil and gas, and that's the symbol MPLX. And I just read an article last month that Bill Gross, who is the bond king, he's the co-founder of PIMCO, and had $280 billion under management. Was a big investor of MPL's oil and gas,
Right.
and in particular MPLX. And this stock, and I'm going to, if you can pull up this screen, I have added to my position of MPLX every single year since 2020. My first purchase of MPLX was in 2020 at just below $18 a share. It's now trading over $40 a share. Still pays an 8% dividend today. Trades at a PE multiple of 10. But Jason, we like to tell stories, and we like to get down into the weeds of the details. And MPLX has 12,500 miles of pipeline that transports oil and gas. And I was calculating the numbers right before this podcast. That's enough pipeline to go back and forth from New York City to Los Angeles over 4 times. That's how much pipeline they have.
Is it just in the U.S. or I guess North America?
North America.
Yeah.
When MPLX went public in 2013, their very first dividend per unit was 17 cents a unit per quarter. Today, it's 85 cents per unit per quarter. So every year, they're paying out $3.40 per unit. Every mile of pipeline they own kicks off over nearly $300,000 in dividends. So every mile of pipeline, that's how much dividends are kicking off.
Are they still building?
I don't know if they're still building or not. I know they've done some acquisitions.
Right.
They're building through acquisitions. So this has been a steady dividend payer and grower for the past 4 years. Now their all-time high is around $80 a share, and it's currently trading at 41. So if it can get back to 80, not only am I going to be enjoying like those dividends, but the capital appreciation is going to buy my next Florida home for me. So
next to the celebrities.
that is the number one dividend stock for me for 2024.
All right, take it to the bank. Don't say we don't give you the freebies on here.
No, we don't. Yeah.
So moving on, overall market-wise, the fear and greed index, right? We were just talking about, CNN has a thing. It's probably the only valuable thing that CNN puts out where they track sort of the investor sentiment of fear and greed. And it looks like it might be about to turn.
Yeah. Kudos to CNN. Like you said, Jason, that's the only thing that we will ever quote coming out of CNN. And for our viewers, just go to CNN or Google CNN Fear and Greed Index, and it'll pull it right up. There are other variations out there of people who do Fear and Greed Index. One is the Wall Street Bets sentiment. The other one is cryptocurrency, Fear and Greed. Yeah. But the CNN Fear and Greed Index it's pretty good. If you look at it historically, it is really good. And I love sentiment. I love market psychology. That's probably the number one thing I really do look at when I'm either buying or selling long term. So the index recently made a bottom in mid-April of this year. The value of it was 31, which put it really deep into the fear
Right.
category. Wasn't extremely fearful, but it was low in the fear index. And it has bounced back since. It's gone from 31 in mid-April to around 40 today. That was a good indicator of making a short-term trade. You could have made a short-term trade on that. Whether it plays out long-term,
Yeah.
that we'll see. But I am still a long-term bull on this market, and I think I think we went through a correction.
Yeah.
This past, this past month.
Yeah, I mean, we saw it just in interest. Just in the market. That the year started off really strong,
Right.
And that's how it goes. The market never goes straight up.
No.
But when you talk to people in the moment, you talk about like market psychology and sentiment. They can't. When that fear, it's like it feeds off of itself, right? And everybody's like, "Oh, I don't know, I'm scared," and you got to basically just be like, "No," like kind of train yourself.
You almost have to swallow your fear. You have to trust. The brain is combating your gut, and it's always, these are the moments that when history books are being written. These are the times that you either have to buy or sell. You have to just look the other way and do it. We've had a few of these moments, just in the past few years. One was the COVID crash.
Yeah.
Everybody, even some of my peers who I respect, a lot in terms of their market acumen, were like, "This is it. The world's over." And when you start hearing things like that.
Yeah. Do you find that people tend to get more like that as they get older too? Like they're more like, oh, like, the world's going to come to an end. You think it's kind of like they're closer to their end of their life, so they like kind of want to see shit burn.
Probably, and as you get older, I think you get more risk averse.
Right.
You want to sort of protect what you've built.
Yeah, if you have, it makes sense. Early on, you can sort of afford to take more risk because on a long enough time frame, the market typically goes up. But if you've already retired or you're approaching retirement and you have, 2008, right? It delayed people retiring for years.
Right.
Because their portfolios just got crushed.
Yeah, and there's a lot of academic studies out there that have I think have a lot of valuable things to say that we're hardwired to be more in survival mode, and we tend to remember the bad things more than we remember the good things. And not to get too cynical, but I think my first divorce, I remember that more than than the marriage.
Oh yeah, absolutely. Everybody, remembers, I think, like where they were during like 9/11 and these like traumatic. There's definitely, psychological evidence out there that it's sort of like, I describe it as like burning into your brain because it's a very traumatic experience. And certain people, I think, even maybe more so lately, are just wired for that, and it's almost like there's this collective PTSD. I think from COVID and these other things that have happened recently that were like world-changing, events for people.
Well, yeah, and I think that's where services like that we offer is so valuable because we sort of take the other side of that viewpoint. And through historical analysis and psychological analysis, we tend to make them argue. Well, this is how humans act. This is these same patterns keep repeating themselves, and this is how you can survive and benefit and profit and excel.
Yeah, it is difficult. It really does become almost like a training you have to do and go through it. And I think that's why, reading from your perspective of being through these things for multiple times has been like, okay, like This is what everybody's thinking. We basically, and I wouldn't say when you describe the idea of contrarian investing, it's not necessarily doing like the opposite of the herd, right? It's just sort of like a different angle on it, right? Like, hey, if everybody's over here doing this, then, we're either going to wait for it to swing back, or that means that in this other area, there's a huge opportunity.
Right. It took me a while to, sort of believe Warren Buffett. And Warren Buffett's favorite, one of his, most quotable quotes is, be greedy when people are fearful and fearful when people are greedy. And he's right. He's absolutely right. Because the human condition, we're always going to bounce back, typically. We are. We're always going to bounce back. So when things look dire, that's when you should be,
right.
Loading up, buying when there's blood in the streets.
Yeah.
And lately there's been a lot of blood in the streets.
Right. Well, and I think at least it's always been like this, I believe, is people think the whole phrase, it's different this time.
Yeah. How many times have you heard that?
Right. Exactly. So, I mean, even during COVID, right, it was like, well, it's been, 100 years since a pandemic. Like we have this mindset of like, hey, we're modern and we're smarter now. So like it's different this time and this is going to have this, but it's just like the world and the visible hand of the market just moves quickly to adjust.
It hasn't changed. It really hasn't. Like the human psychology has not changed. Human nature hasn't changed. The technology has changed. The communication has changed.
Right.
We have instantaneous communication now, and say this, look at COVID versus say the Spanish flu and how different that was. But we're 2 or 3 years away from sort of the COVID lockdowns, and now we're looking back and thinking like, wow, how did we fall for this stuff? How did we fell for it? And if most humans, most people did. I mean, there were some people out there say, hey, come on, this is a little bit, we're getting a little exaggerated here. This is a little crazy. But for the most part, everybody fell in line.
Yep.
They wore their masks.
Well, I'll tell you what, there's still people out there.
There are still people out there doing it, right?
It's interesting.
Fear, in my opinion, is the most powerful emotion. It's more powerful than greed, love, whatever.
Mm-hmm.
It can change you.
So I mean that leads to the central bank idea. We've talked a lot about central bank digital currencies and whether sort of fear is going to come from that. But the other thing you were just talking about that central banks were doing is just buying gold.
Yeah. And let me back up a little bit, Jason, on this. We've been talking about this for a long time, okay? So whereas COVID was like a flash, it just came out of nowhere, right? We've been talking about this for a long time, and it's playing out over a long period of time. I give this a lot more credence than I do COVID, for instance, the fear.
Right.
Because you can watch what's happening in, say, the gold markets. Central banks around the world have been buying gold bullion in record numbers, and particularly the Chinese central bank. They have been buying gold for 17 months straight. And since 2019, they have increased their gold reserves by 50%. So you don't have to, I've been saying this, watch the behavior of central banks, and not them printing money. Watch how they're buying gold. They're buying tons of gold.
Right.
And this is, for me, this is sort of the canary in the coal mine. Like, what are they seeing that, and we talk about this, what are they seeing that makes them fearful that they're buying gold,
mm-hmm.
Buying record amounts of gold. And, it's everything that we've always talked about, the dollar, our sovereign debt, our national debt, geopolitical unrest in Europe and the Middle East, there's sort of cultural conflicts in the U.S. right now. It's sort of this age of uncertainty, age of chaos, and when push comes to shove, people, investors, individual investors, central banks, they all want a safe haven asset, and there's nothing that's more safe haven than gold. It stands the test of time.
Yeah, I mean, going back thousands and thousands of years.
Yeah.
So, you know, people talk about Bitcoin being the new sort of like inflation hedge, but it's only been around for 10 years, or I guess going on 20 years now, I guess. But compared to gold, that's nothing.
Yeah, and let me just let me get on my soapbox a little bit on this.
That's why you're here.
That's why I'm here. So I believe that we are in a new gold bull market, in silver bull market, and just for historical reference, we started Angel. I started Angel right when the gold bull market in the early 2000s was just getting started, and if you remember back then, we had a series of crises. One was the .com bust that happened in March of 2000. We had the terrorist attacks of 2001, the invasion of Afghanistan, the invasion of Iraq, record low interest rates, which pushed a housing market to a boom and bust. But what were we saying, Jason? Buy gold, buy silver. And gold went from, I don't remember the actual number.
It was like
$250 an ounce. And it went all the way almost to $2,000 an ounce by 2011. And that was a gain. That was a gain in gold of about 600, a little bit over 600%. I think we're going to see the same thing again now. I think we are in another cycle where gold and silver are going to do extremely well. So based on that, I have some pretty extreme gold price targets.
Oh yeah.
Yeah. So,
well, I mean, if it's $2,000 an ounce now,
right, and I've been right. I don't want to be arrogant about this, but I've been right. Last year, I said, yeah, gold is going to be breaking above $2,000. My 1 year target for gold right now is a little bit. I've got $2,573 an ounce. How's that for specificity? My 2 year target for gold is $3,138. That's my 2 year target. But I think over the course of the next 10 years, we're going to be going between $10,000 and $12,000 an ounce. Now, when I tell people that, they're like, yeah, that is crazy. Okay? But had you said that in 2003 when gold was at $250 an ounce and you said, yeah, gold's going to $2,000, you would have got the same reaction. You would have got the same reaction.
Yeah.
So it's all relative. So that is, in terms of like the physical gold, those are my price targets. But I'm very excited about this new asset class that's about to be launched, Jason. It's called NatGold.
Okay.
And it's a merging of physical gold and cryptocurrency. Now, we've already seen this. The Hong Kong bank, HSBC, recently launched a token that's backed by physical gold. NatGold, however, is different, and that it is going to be backed by gold that has yet to be mined, but is also a proven resource.
Okay.
So, and there are various reasons why this is beneficial. Mainly because there's no environmental damage done. The expense of mining that gold is expensive. This new token is going to be backed by gold that is still physically in the ground and not mined yet.
Interesting. So you don't have to go through the process of basically digging it up and then burying it again.
And burying it again, right? It's been buried. And I would urge our viewers to go to natgold.org, where you can see the birth of this new token happening right now.
Right.
You can go there. You can sign up to NatGold News and Insights, their newsletter. I just gave an interview, a pretty lengthy interview to the council, and this is one of the most exciting things that I've come across in a very, very long time.
It's interesting to see because crypto and gold has almost been like at odds, right? It's like, oh, the gold bugs, like the Peter Schiff's. Like Peter Schiff's on Twitter now, just, he just 10 times a day is shitting on Bitcoin and gold. And then, the Bitcoin people come and it's just like, oh, gold's for you old. Like, so now this is like basically like, hey, they could all come together and be buddies.
Well, for me, this is the merging of the old and the new, right? It's if you look at, and I've done a lengthy article. I did a lengthy article that's being published right here, right now, where I go through the history of not just gold as money and currency, but also as Bitcoin and cryptocurrency as gold and money. You'd be shocked. Our readers might be shocked to know that really the concept, the theory of Bitcoin dates back hundreds of years. And it started off in a micro Indonesian island called Yap, where they used these giant stones called ray stones as stores of wealth and value. Okay, and it was a communal ledger like they use now in blockchain. So again,
the original blockchain.
Human nature doesn't change; just the technology changes. So.
All right. Yeah, that's really exciting. And we'll put the links in the description to visit all that stuff. And I think that's a good spot to end it. And
Perfect.
We'll get you back on here. And don't forget to check out Brian's newsletter, The Rich Report, which has been publishing since the beginning of this year, right?
Yeah, and our portfolio it's doing fantastic. Our portfolio, I would say, is 90% dividend-paying stocks. We have a little bit of speculation in there,
right?
But overall, it's been a great income driver.
Yep, and that's what we all want.
Yep.
All right, don't forget to like, subscribe, comment, and we'll see you next time.